My name is Tom Clendon, and I'm a 3 times PQ Award winner. And I'm delighted to be linking up with PQ again to bring you another of a Back to Basics video. This topic is about impairment, International Accounting Standard 36. Now, when we say an asset is impaired, it's a bad thing. It means the asset is somehow damaged, that we're not going to be able to recover the amount of the asset that appears in the carrying value of the books at the moment. So an asset is impaired when the carrying value, the figure in its books, exceeds how much you can recover from that asset. Now, there are 2 different ways that you can recover from an asset. You can either sell it, fair value less cost to sell, you can sell it, or you can keep it. You can exploit it. You can use it to generate value in the future. You can use it to generate cash flows. And the recoverable amount will always be the higher of what you can sell it for and what you would get if you were to keep it, that estimate of what you would get if you were to keep it. Now, the value in use is a particularly technical term. What you would get if you keep it, it is the present value, in other words, discounted, the present value of future cash flows. We're not going to get involved in those detailed calculations. This is a basics video after all. But what I do want to do is to make you think. What I do want to do is show you application. What I do want to do is to teach you through questions. The asset is in the books at 100. You can sell it for 40, fair value less cost to sell, or you can keep it and the present value of the future cash flows will be 65. What's the impairment loss? How's it going to be accounted for? Well, first things first, you would keep it, wouldn't you? You wouldn't sell it for 40 if you think actually it's going to be worth 65 if you keep it. So the recoverable amount is the higher of the fair value, less cost to sell, and the value in use. And in this context, you can recover 65 from the asset. But it's in the books at 100. And because it's in the books at 100 and you can only recover 65, your loss is the difference. Your impairment loss is 35. That's the difference between the current carrying value and the amount you can recover. You're writing it down, which is prudent. You're writing it down to the recoverable amount. So the impairment loss is 35. And it's accounted for by charging the loss to the P&L and writing the asset down by 35. And if you love double entries, you'll appreciate that's a debit to the P&L, an expense. Expenses go up, profits go down, and you are reducing the carrying value of the asset from 100 by 35 to 65. You're crediting the asset on the statement of financial position. Let's have a look at another example. Let's have a look at example number 2. What's the impairment loss? How's it going to be accounted for? This time the asset is in the books at 400. You can sell it for 250, but if you keep it, you'd only get 100. Well, you'd be mad to keep it, wouldn't you? You are going to recover by selling this asset. And when you do sell the asset, there will be a loss. So we're going to anticipate that loss. The recoverable amount will be 250 because it's the higher of what you can get from keeping it or selling it. The carrying value is 400, but you're only going to get back 250. Therefore, your impairment loss is 150. You charge that against the profit, you debit the P&L, and you credit the asset by the amount of the impairment loss. Had you been able to sell the asset for 450, there wouldn't have been an impairment loss, and please don't ever talk to me about impairment gains. So, to recap, where there is an impairment loss, you must write the asset down to its recoverable amount. The debit and credit does not involve any money changing hands, so there is no cash outflow from an impairment loss. It's an accounting entry. It's an estimate. Yeah, it's an adjustment that we make to profit. Oh, one last thing. I say it's an adjustment we make to profit, but that's not 100% always the case. Because if the asset has previously been revalued, then the impairment loss can first of all be allocated to the revaluation reserve, to equity, until that previous revaluation has been exhausted. So the P&L is not always charged. It's normally charged, but you would charge it against equity, other comprehensive income, if the asset has previously been revalued. Thank you very much for listening to this little back to basics exercise on ISA 36 that I have done in conjunction with PQ Magazine.